In this lecture, we're going to be focusing on test of controls and substantive testing, specifically related to the acquisition and payment cycle. Keep in mind that the test of controls is a part of the control risk assessment that we do that is a part of the risk of material misstatement. The auditor needs to determine to what extent they're going to be relying on the controls within the organization as they determine the nature, timing, and extent of the substantive procedures. In addition, test of controls are going to be critical as the auditor assesses the internal control risk related to financial reporting as related to the Sarbanes-Oxley 404 testing, which is part of this integrated audit. So let's focus initially on the test of controls, and again, we're focusing on the test of controls from the perspective of understanding the risk related to the organization, the control risk related to the organization. Internal controls are to be tested to make sure that payments are authorized for goods and services. You notice the term authorized is related to a transaction and related to a management effect related to developing an internal control. That these amounts are made in the appropriate amount and in the correct time period and paid only once to an authorized vendor. So you notice the payment is made, and you notice also that we have controls specifically related to authorizing vendors. Typical test of controls includes inquiry and observation. Very interestingly, that internal control testing, generally speaking, always starts with the auditor observing the process and making inquiries of management and relevant personnel. And the reason that we're doing this is we're attempting to gain an understanding of the internal control process. Keep in mind that as we're doing these tests of controls, we're going to be documenting these controls. We probably will be documenting these controls from a flowchart perspective. We've seen a number of flowcharts in these discussions. We also may be writing a narrative, or the documentation may be a part of an internal questionnaire. We're going to be examining documents to corroborate that the control has been performed. Recall the discussion that we had related to attribute sampling. In attribute sampling, what we're looking for is the specific attribute on a document that validates that the control process was working appropriately. Reperformance is also another test of control, and the auditor in this case is going to be looking for the process, looking at the process and determining from his or her reperformance that controls are operating effectively. So let's talk about this control process if in fact we identify control deficiencies. If we identify control deficiencies, we need to determine the severity of these controls. We will also need to modify our preliminary control risk assessment. And again, keep in mind that the control risk assessment is a part of assessing the risk of material misstatement. And this is absolutely going to drive the type and the amount of substantive testing that we're going to be doing. In any case, we're going to be documenting the implication of the control process. When no control deficiencies are identified, we determine whether the preliminary risk assessment is still appropriate. We're going to determine the extent the controls can provide evidence to the correct account balances and determine and plan our substantive audit procedures. So let's now focus on substantive procedures. We're looking at substantive procedures related to the account of cost of goods sold. Again, anytime you use the word substantive, what we're looking for is we are looking for monetary misstatement. That when we do test of controls, we are assessing the control risk. When we are doing substantive testing, we are measuring monetary misstatement. The audit results or the audit opinion is based upon our substantive procedures and the determination whether or not the financial statement account balances are materially misstated. So related to cost of goods sold, what we're looking for is we want assurances that inventory exists. Existence is an attribute, a management assertion. We want to make sure that the inventory is actually owned by the company, so rights, and then we want to make sure that it is valued appropriately. To do this, we should perform all relevant assertion testing. Significant acquisition and payment cycle account disclosures, including substantive analytical procedures related to reasonableness and our test of details. Some of the things that we're going to be doing is review the client's proposed physical inventory procedures. Is it a complete and accurate physical inventory? Is it likely that they're going to be able to do a physical inventory count? Now you notice that our role is to observe the client's count of the annual physical inventory. Keep in mind that this means that we are not doing the count, but we are observing it. We are making test selections that can later be traced into the client's inventory compilation. We should emphasize high dollar volume items, trace the counts of the inventory compilation, and test of these client computations of extended pricing, and look for evidence of slow-moving, obsolete, or damaged inventory. So let's kind of walk through a couple of these and make sure that we understand what's taking place. So as we are counting the inventory, what we're attempting to do is we're attempting to determine whether or not the physical count of management is appropriate. We also want to look at the extended costing specifically related to the inventory. So we're going to do this by examining our the vendor invoices and determine if in fact the price is appropriate. And then as we're looking for evidence of slow-moving, obsolete, or damaged inventory, this is when we are considering the concept specifically related to our valuation. So if in fact we do have slow-moving or obsolete inventory, these items should possibly be marked down through the process of lower cost or market. If we have damaged inventory, this is something that we need to consider from the perspective of perhaps this inventory should not even be on the inventory list. Part of the assertions related to year-end cutoff. Last shipments received and document numbers used before the inventory count is taken. We review the purchase and sales orders just before and after year end. We want to note any shipping or receiving document numbers to determine whether the goods were recorded in the proper period. We also want to make inquiries related to goods on consignment. When we make inquiries related to goods on consignment or located outside the warehouse, we are looking for existence for those outside the warehouse, but we're looking for rights in regards to those goods that are on consignment. If material, either visit these locations or send confirmations to the outside warehouse management. Allowance for returns. We need to determine the client policy for accounting for the returns. We want to review the receipt of transactions for selected periods to determine whether significant returns are received and appropriately accounted for. It's very possible that returns are a part of the revenue cycle, and they're accounting for this based upon an indirect method by creating an allowance for returns. If this is the case, what we're going to be doing is we're going to be examining the returns and comparing these returns to the time period in which they've been returned. In fact, the allowance for returns is a very good opportunity for us to consider using an analytical procedure. When we're considering the cost of goods sold, rights and obligations, we review vendor invoices when testing distributions to determine the proper title is conveyed. We review purchase contracts to assess rights of return of the merchandise. Valuation and allocation, determine whether the valuation method is appropriate for the client. Inquire of production and warehouse personnel about the existence of obsolete inventory. Again, obsolete inventory, we're considering this from the valuation perspective. We may in fact also want to talk to sales personnel to determine if in fact there are inventory that is difficult to sell. Note, potentially obsolete inventory while observing physical inventory counts. It's very easy to note obsolete inventory. If you see an excess of inventory, maybe you're going to see an inventory that has a lot of dust on it. It's possible that this inventory is there because nobody is selling it. Well, if this is the case, it's very possible that this inventory needs to be wrote down. Trace potential obsolete items to the client's inventory compilation and determine whether they are properly labeled as obsolete item. Continuing our discussion related to valuation and allocation, test inventory by taking a sample of recorded inventory and trace to source documents. Test standard costing system. Test for possible obsolete inventory that should be marked down to market value. When we're considering the costing system, we need to consider it from the perspective of, is this a manufacturer? If this is a manufacturer, there's going to be standard costing system considerations as these items flow through the manufacturing process in terms of the absorption of cost into work in process as well as finished inventory. Auditors also need to understand in a perpetual inventory system the authorized receipts and sales of the inventory, if they're properly and accurately recorded, and only authorized receipts and sales of inventory has been recorded. So if the organization uses a perpetual inventory system, this needs to be compared to the results of the physical inventory, and any discrepancies needs to be examined to determine why that inventory is not on the shelf and yet not a part of cost of goods sold. When we're considering presentation and disclosures, we need to understand that the financial statement disclosures is going to talk about the inventory valuation method, whether it be FIFO, LIFO, the percentage inventory valued by different methods, classification of inventory. We certainly would be interested in determining if in fact they changed methods regarding the standard FIFO or LIFO or average costing, and looking for inventory policies regarding returns and allowances. Fraud-related substantive procedures: observe all inventory locations simultaneously. The reason we're doing this is it is not uncommon for organizations to essentially have the auditor count one area. As they leave this area, they then shift the same inventory to another location. Auditor comes and counts that, and basically the inventory is counted twice. Confirm inventory at locations that are outside the entity. Compare the carrying value amount to recent sales. This would be an analytical procedure. Examine consignment agreements. Send confirmations to the vendor to confirm invoices and unusual items, and determine if there are bulk sales at steep discounts. Now we're looking at accounts payable and other related expense accounts. If there is little risk of an understatement of accounts payable, testing might be limited to substantive analytical procedures. When evaluating evidence regarding expense accounts, auditors should consider that management is more likely to understate rather than overstate expenses. They're more likely to classify expenses as assets rather than vice versa. And most relevant assertions related to expenses is the completeness assertion. Again, when we're looking at expenses and payables, we're clearly interested in making sure that the reported amount is in fact complete. The other issue clearly relates to expenses that are classified as assets rather than expenses. This essentially is a technique that organizations use to manage their earnings. If we look at Exhibit 1112, I won't spend too much time on this, but this actually gives you an opportunity to consider specific audit procedures as they relate to specific assertions. So the existence and occurrence, we're performing a cutoff test. Completeness, we request vendors' monthly statements. We agree monthly statements and confirmations from major vendors. Rights and obligations, we review long-term purchase commitments. Valuation, use some sort of mathematical accuracy to determine that accounts payable agrees with the general ledger. And presentation and disclosure, we are reviewing the actual disclosures. In accounts payable, the first thing that we want to consider is how much of our substantive procedures can be performed through analytical modeling. Analytical models using either audited data or independently generated data specifically related to expenses, expense accounts, and essentially what we're looking for is through a ratio analysis determine if these expenses fall within a specific range. If they don't, then we're going to investigate why they don't. This actually gives us an opportunity for a very detailed review of where we need to focus our attention as we are completing our audit. Review of unusual entries to expenses, expense accounts. The vast majority of transactions should be debit accounts, debit transactions. So if we see an unusual amount of credit transactions, well, we need to find out why this might be. Exceptions to this rule are accounts that represent estimates or accounts that are based upon relationships with specific assets, depreciation, bonds, and so forth. When we're looking at accounts payable and related expense accounts, we need to consider fraud-related substantive procedures. Again, when we talk about substantive procedures, we are measuring monetary misstatement, and we are considering the effect that fraud may have related to the material misstatement of these account balances. One of the things that we might do is send blank confirmation to vendors so that they're going to furnish information to us related to outstanding invoice, payment terms, payment history. Scan the journal for unusual or large year-end transactions. Review client vendor file for unusual items. I've completed audits where we've considered the vendor file and then matched these with employee files. The reason that we're doing this is we were looking for a match between the employee's address and the vendor address, and this essentially may in fact imply that there's some sort of fraud being perpetrated. Obtain and examine documentation for payments of invoices for amounts just under the limit that typically is required for some approval. The auditors that conducted the audit that I was involved in, essentially what they were looking for is they were looking for transactions that ended in 999 and 998 directly below a threshold of approval. And the reason they were doing this is to determine if in fact management was creating some sort of workaround related to the approval process. Documentation of our substantive procedures, absolutely important. We need evidence about the physical inventory observation, about product costing. And again, when we talk about product costing, we are detailing this from the vendor invoices pertaining to net realizable value calculations. Anything that we're doing, what we need to do is we need to document it. And the sort of the general rule of thumb is it's always better to over-document than to under-document. Because what's going to be taking place is a reviewer is coming behind you, and he or she is going to be looking at your results and your conclusions and seeing if in fact the conclusion is appropriate. Well, if you don't have things documented, it's very difficult for the reviewer to determine if in fact the review was done appropriately. Okay, so I thank you very much for your time and attention. This actually provides some very good background specifically related to our accounts payable and our substantive testing, both for accounts payable and inventory. Everybody have a great day, and we will talk to you in our next chapter. Thank you.